Welcome. In this presentation, we walk through New Zealand tax residency, a complete decision guide for both individuals and companies. Whether you're moving to New Zealand, leaving for an extended period overseas, or running a business with cross-border ties, your residency status determines how you're taxed. We'll cover four key areas. First, the individual residency rules. Second, the concept of a permanent place of abode, often referred to as PPOA. Third, the company residency tests, and finally, special residency status including the 4-year transitional relief for new migrants, and the rules for seasonal workers. Three numbers will keep coming up: 183 days, the presence test, 325 days, the absence test, and 4 years, the transitional relief period. Everything we discuss is grounded in Sections Yard 1 and Yard 2 of the Income Tax Act 2007. Let's get started. Let's begin with how individual residency is determined under Section Yard 1. There are essentially four conditions to keep in mind, and they work together to decide both when you become a resident and when you cease to be one. The first and most important is the PPOA test, the permanent place of abode test. This is the primary test. If you have a permanent place of abode in New Zealand, you are a tax resident, regardless of how many days you actually spend in the country. Residency takes effect from the date the PPOA is established. Next, the 183-day test. If you are personally present in New Zealand for more than 183 days in any 12-month period, you are deemed a resident, and importantly, your residency is backdated to the very first day of that 12-month window. There's also a government service exemption. If you are away from New Zealand while in the service of the New Zealand government, you remain resident throughout the entire absence no matter how long you are away. Finally, the 325-day test, which is how residency is ceased. If you are absent from New Zealand for more than 325 days in any 12-month period, and you have no permanent place of abode during that time, you cease to be a resident from the first day of that 325-day absence. Now let's look closely at how those day counts actually work, because there are a few rules that often catch people out. The two thresholds to remember: 183 days for presence, that's how you become a resident, and 325 days for absence, that's how you cease to be one. Three rules govern how the days are counted. First, part days count. Any part of a day, even arriving at 11:59 p.m., counts as a full day of presence in New Zealand, so a quick stopover or a late night arrival is treated the same as a full day. Second, it's a rolling 12-month period. The window is not tied to the tax year or the calendar year. It can start on any date, so you need to check whether any 12-month window crosses the threshold, not just the most recent tax year. And third, the hindsight rule. You may only realize you became a resident after 183 days have already passed. But once you cross that line, your resident status is backdated to day one of the period. That backdating can have significant tax consequences, so it pays to track your days carefully. Now to the permanent place of abode, the PPOA. This is the primary test, and it overrides all the day count rules we just looked at. The leading cases here are Sir versus Diamond and Van Uden versus Sir, both of which shape how this test is applied today. There are three things to consider. 1. Availability of a dwelling. You must have a place available to live in New Zealand. It does not have to be owned by you. It can be held in a trust or owned by a family member. What matters is that it's available. 2. Usage. The dwelling must be a place where you could live on an enduring basis. And here's an important nuance: even if the property is currently rented out to other tenants, it can still count, as long as it remains a place where you could realistically live. And 3. Durability of ties. The courts look at the totality of circumstances. That includes your family and social ties, your business interests, and where your personal property is stored. No single factor is decisive. The question is whether, taken together, your connections to New Zealand are durable and enduring. Companies are treated under a different section, Section Yard 2. The rule here is simpler in structure, but broader in reach. A company is a New Zealand resident if it meets any one of four criteria. Just one is enough. Test 1: incorporation. If the company is incorporated in New Zealand, it is resident, full stop. Test 2: head office. If the company's head office is located in New Zealand, it is resident. Test 3 Center of Management. If the company's center of management is in New Zealand, it is resident. And test 4 Director Control. If the directors exercise control of the company in New Zealand, in their capacity as directors, the company is resident. The key takeaway: meet even one of these tests and the company is treated as a New Zealand tax resident. So when structuring cross-border operations, all 4 tests need to be considered together. Finally, 2 important special categories. First, transitional residents. This is a generous concession aimed at new migrants and returning New Zealanders. You qualify if you are a new migrant arriving in New Zealand for the first time, or a returning New Zealander who has been absent for more than 10 years. The benefit is a 4-year tax holiday on most foreign-sourced passive income, and it applies automatically once you become a tax resident. For people moving to New Zealand with offshore investments, this is one of the most valuable rules in the entire system. Second, non-resident seasonal workers. These workers are always deemed non-resident, regardless of how many days they spend in New Zealand. This is a statutory override. It cannot be displaced by the 183-day test or by the PPOA test. It applies to workers admitted under a recognized seasonal work scheme, and the standard withholding tax rules for non-residents apply to their New Zealand earnings. That brings us to the end of our overview of New Zealand tax residency. 3 numbers to remember: 183, 325, and 4 and 2 sections of the Act. Yard 1 for individuals, and Yard 2 for companies. Thank you for watching.